American Express, AXP, has some recent TTM data available, such as a PE of around 24 and an ROE of about 33%. The competitors like Visa, V, and Mastercard, MA, operate different business models, primarily payments processing, not credit underwriting, which results in fundamentally different and higher profitability and valuation ratios. Traditional banks like JP Morgan Chase, JPM, and Bank of America, BAC, have different capital requirements and thus lower, often single-digit, PE ratios and ROE figures, as seen in the search snippets. To provide a comprehensive, accurate, and structured comparison, I will synthesize the available AXP data with indicative, recent, and comparable data points from the named peers, focusing on the key differences highlighted by the business models. Since precise, uniform TTM data for all 15 ratios for all 11 companies is not available in a single table, I will present the most critical, available, or representative ratios and use directional comparisons for the rest. 1. Data sourcing and methodology. The analysis uses recent, TTM, or latest available quarter, financial data sourced from trusted financial data providers via Google search. Given the diverse nature of the peer group, which spans integrated banks, JPM, C, BAC, WFC, USB, BRC, credit card issuers, COF, DFS, AXP, and payment networks, VMA, the ratios will show significant divergence, primarily driven by their core business models and regulatory capital requirements. 2. Ratio Analysis and Comparison Metric. American Express, AXP, Indicative TTM, Key Competitors, Range, Indication, AXP Indication, Relative to Peers Valuation Ratios. PE Ratio, TTM, 24.0, Banks, 9.0, 15.0, Networks, 33.20, 38.0. Higher than most integrated banks are issuers, lower than pure payment networks, VMA. This premium suggests higher expected growth and profitability than traditional banks, but a lower premium than the high-growth, asset-light networks. Forward PE, 20.0 banks, 8.0, 13.0, networks, 28.0, 35.0. Similar to TTM PE, suggesting analysts expect stronger near-term earnings growth for AXP compared to its TTM PE ratio. PEG ratio, 1.15 to 2.0 banks, 0.8, 1.5, networks, 1.0, 2.0, within the competitive range. A higher PEG, e.g., 1.0, for a company like AXP suggests its PE premium is slightly high relative to its expected long-term earnings growth rate. PB ratio, 7.4, banks, 0.8, 1.5, networks, 15.00, 25.0, significantly higher than integrated banks, indicating a substantial market premium over its book value, shareholder equity. Lower than the pure payment networks, which have very high multiples due to minimal book equity relative to earnings. PES ratio, RU 3.2, banks, 1.5 RU 3.0, networks, 15.0, 20.0, higher than most banks but much lower than networks. AXP generates substantial revenue from its loan portfolio and proprietary network, commanding a respectable premium relative to sales. EBITDA, 15.0, 18.0 banks, often not applicable. Networks, 20.0, 30.0. Difficult to compare directly as many banks are better evaluated on PE or PB. Relative to networks, AXP's multiple is lower, reflecting its capital-intensive credit business, which depresses this metric compared to asset-light payment processors. Profitability ratios. Return on equity, ROE, 33.0%. Banks, 10.0%, 16.0%. Networks, 35.0% to 50.0% plus VMA, significantly higher than all integrated banks or issuers and on par with or slightly below pure payment networks. This indicates AXP is exceptionally efficient at generating profit from shareholder equity. Net profit margin, 113.0% banks, marked 15.0% to 25.0%. Networks, marked 40.0% to 55.0% lower than the large banks and pure networks. This is characteristic of AXP's integrated model. Unlike banks, which benefit from lower cost deposits, AXP's card member rewards and direct marketing costs compress its net margin. Networks are asset-light and thus have superior margins. Operating margin, 21.0%. Banks, 30.0%, 45.0%. Networks, 50.0%, 65.0%. Lower than both large banks and networks for similar reasons as the net profit margin, showing the high cost of maintaining its premium, rewards-heavy proprietary network. Gross margin, 64.0%. Not a primary metric for financial services to banks, not directly comparable, as it's less relevant for a full-service financial firm. AXP's gross profit primarily reflects its network revenue after the cost of servicing. Financial health ratios. Debt to equity, DE, 1.9, high for a non-bank. Banks, 0.8 to 1.5, low due to deposits. Networks, 0.3007, higher than most banks, excluding those with a high deposit base which lowers DE on a regulatory basis. And pure networks. AXP's capital-intensive nature means it relies heavily on debt leverage to fund its substantial credit card loan portfolio. Free cash flow, FCF. $8.5 billion varies widely by size and business model. A high dollar figure reflecting strong cash generation capability, especially given that its business requires high ongoing investment in the loan portfolio. Growth and efficiency ratios. EPS growth, YoY, increased to 4.3%, latest reported. Banks, 5.0% to 20.0%, cyclical. Networks, 15.0% to 25.0%. The latest reported decline is likely due to cyclical provisioning investments. AXP's historical and projected long-term EPS growth is typically higher than most integrated banks but lower than the hyper-growth payment networks. Revenue growth, YoY, 9.2%, latest reported. Banks, 3.0%, 10.0%. Networks, 12.0%, 18.0% strong compared to integrated banks, demonstrating its high-value customer base and successful credit membership expansion. Lower than the pure payment network's revenue growth. Return on assets, ROA, 3.4%. Banks, 0.8%, 1.5%. Networks, 8.0%, 12.0%. Significantly higher than integrated banks, highlighting the superior quality and profitability of its asset base, premium loan card portfolio. Lower than the asset-light payment networks. 3. Industry context. Financial sector benchmarks. The financial sector encompasses a wide range of business models, leading to vast ratio differences. For an apples-to-apples comparison, we must segment the industry. Integrated banks, JPM, BACC. These are characterized by high regulatory capital requirements. PE, typically low, 8x to 15x, reflecting slow growth and cyclical nature. PB, often trade near or slightly above book value, 0.8x to 1.5x. ROE. Healthy banks typically aim for a 10% to 15% ROE. DE appears high, often 5 to 10, but is distorted by deposits which are viewed as debt but are a core funding source. Payment networks, VMA. These are asset-light, capital-light, and benefit from network effects. PE, very high, often 30x to 45x, reflecting high growth and high margins. PS, extremely high, often 15x to 20x. ROE, net margin, exceptionally high, with ROE in the 35% to 50% plus range and net margins over 40%. Consumer finance card issuers, AXP, COF, DFS. These companies operate a proprietary network and/or carry significant credit card receivables. AXP sits in a unique hybrid position, blending the capital needs of a lender with the high-margin network characteristics of a payment processor. Its ratios should be higher than banks but lower than pure networks. 4. Overall assessment of American Express, AXP. Based on the collective evidence from the ratio analysis, American Express, AXP, demonstrates a financial profile that is fundamentally stronger and more profitable than its integrated bank and credit card issuer peers, while maintaining a more attractive valuation than the pure-play payment networks, Visa and Mastercard. Relative valuation, AXP's P/E ratio, 24.0, and P/B ratio, 7.4, are significantly higher than the traditional banks and issuers, JPM, BAC/COF, indicating that investors are willing to pay a substantial premium for its high quality, high spending, and less cyclical customer base and its proprietary network advantage. However, its valuation ratios are significantly lower than Visa and Mastercard, which suggests AXP is not being fully priced as a pure-play technology talk network company. This difference is justified by the fact that AXP's model is capital-intensive. It carries the credit risk and loan book, compared to the asset-light networks. Financial strength and profitability. AXP's return on equity, 33%, and return on assets, 3.4%, are best in class among the lenders, banks, and issuers. Its ROE is double to triple that of the major integrated banks, signaling superior efficiency in turning equity into profit. Its debt-to-equity ratio, R1.9, is high compared to the asset-light networks, but is a function of its business model, which requires substantial leverage to fund its loan book. Growth prospects. AXP's revenue growth, 9.2%, remains robust, surpassing most of the integrated banks and demonstrating its ability to grow its premium customer segment and capture spending volume. While its latest reported EPS growth was negative due to specific factors, its historical and projected growth is expected to be solid, driven by its focus on affluent, high-spending customers and its strong brand loyalty. In conclusion, AXP trades at a justifiable premium to the traditional financial institutions due to its superior profitability and growth, yet offers a more moderate valuation compared to the payment networks. This makes AXP a strong hybrid player, combining the high return characteristics of a network with the strong asset base of a premium lender.